Can you imagine for a moment almost the $80 trillion that the US financial sector has in assets? Kind of crazy, even more than national debt. But we're going to break down in this video exactly what sectors it's into. And it's interesting to see because there is a visual that I'm going to show with this from Visual Capitalist, that is from the Federal Reserve, really breaking down the asset classifications. So when we start thinking of the US financial sector, it holds almost $80 trillion, with the largest of this institution being banks, mutual funds, and insurance companies. So when we start thinking about those larger banks, looking at JP Morgan, Bank of America, Wells Fargo, they are holding a bulk in the largest bulk of money within the nation. Now, we know that banks and credit unions historically pay a pretty low rate on savings accounts, but they are sitting on all of those financial assets, which again is kind of crazy. When you start thinking of banks and credit unions in general, they hold 35% of total assets of major institutions, growing by roughly 5.6% on average, meaning they are getting more deposits. We are seeing more funds. We are seeing more money essentially funneled into these places. Now, when you think of direct deposit, when you think of IRA accounts, when you think of the monetary transactions, that is how all of this money is going there. 5.6% average annual increase since 1998. So we're looking at an extended amount of time, 27 years, it has been 5.6%. So even through the dot-com bubble, looking at the housing market crash, even through COVID, on average, we are still seeing more money put into these banks and credit unions. When we start looking at mutual funds, they grew at 8.3% annually over the same period of time, led by the giants. When we think of Vanguard, when you think of Fidelity, some of these companies that are just massive, massive in size. Breaking down some of the financial sectors, the financial side, I come from banking. Last year, 4,750 commercial banks and 4,600 credit unions held $27.7 trillion in assets. So when you think about that, we are talking almost 9,500 institutions in the United States itself. I was not aware there were that many commercial banks and even that many credit unions. They are almost running neck and neck, according to the Federal Reserve. And of course, JP Morgan is the largest bank in the United States, 3.6 trillion in assets as of September 2024. So when you think of the 27 they hold, Chase holds almost $4 trillion of that. And then the rest of it, of course, is split among those other financial institutions, but followed by Bank of America and Citibank. Bank of America coming in at 2.6 trillion, and then Citibank coming in at 1.7 trillion. Now, when we start looking at the mutual funds, this is another one that's pretty interesting. Mutual funds carry 7,222 funds in America as of 2023, holding $21 trillion in assets. So again, another large chunk of what we have as far as assets. This again is those large companies. When you think of BlackRock and Vanguard, Fidelity, all of these huge ones, roughly 1 in 2 Americans households are invested in mutual funds. Now, interesting enough, to know the cost of mutual funds and the cost of ETFs, the Federal Reserve does not specifically note and doesn't break them apart. When they come to mutual funds, when they break out the mutual funds come in their entirety, meaning there's no diversification. There's no way to break out the ETFs that they do have in there. So I'm hoping that we don't have everyone holding into these really large, expensive mutual funds instead of the ETF or the smaller brother. Now, over the last decade, we have seen ETF and ETF investing surpass $10 trillion, which is kind of crazy. When you start looking at the segment, there is a ton of money coming in there. And then the third largest one within here is insurance companies, $13.3 trillion in assets. When you think of insurance companies and the ability to generate money and protect our assets, a lot of people are saying you're kind of paying for almost nothing if you pay for insurance your entire life and you never have any claims, you never do anything like we haven't. Unfortunately, all of the money is kind of for naught because you're not using any of it, but I know just in case it's always there. Now, when we start looking at life insurance firms, they hold almost 10 trillion of the $13.3 trillion in assets. So it's kind of crazy thinking of New York Life Group and Northwestern Mutual. They stood as the 2 largest and biggest insurance firms in the United States based on the value of direct premiums written. In short, these are the premiums paid by consumers or customers every single year. which again is kind of crazy to think of the amount of money that is going into New York Life and, of course, Mutual Group in relationship to what they're paying out because they're sitting on almost $10 trillion in assets. Now, when we start thinking about hedge funds in general, the big thing with hedge funds is the boom that we're seeing. Now, what we mean by this is when you start looking at hedge funds and the growth over the last couple of years, it has been crazy to see the rise of Nvidia and Meta, Apple, all of these companies that are in really the big tech companies that are booming and have been for the last 2 years. And we're starting to see that trend kind of continue into 2025. It's going to be interesting to see exactly where it does. And amid the booming market, hedge funds and assets grew at the absolute fastest rate, 16.3% between Q2 of 23 and Q2 of 24. So in 1 year, jumped 16.3%, which again, that is a pretty big jump. And then again, hedge funds leverage stood near the highest level in history. That is right. So even though we have a lot of money, we're seeing a lot of growth. Hedge fund managers are still taking and reflecting a very strong risk appetite, meaning they're going above and beyond the investor optimization and optimism, investing and looking at these. So let's take a look at this visual because it is really cool to see when you start breaking it down and looking at the size of the US financial institutions. So looking at the total, we are sitting around $79 trillion for the size of these financial institutions. That, of course, when the national debt's around 34, so we're over double the asset class that we have in the national debt, which is kind of sad that we have $34 trillion in the national debt, and it continues to increase. It seems like it's slowly catching up the asset classes in general. But looking at mutual funds, this again is one of the second largest chunk, 21 or $20.9 trillion in mutual funds. That is a combination of mutual funds and a combination of ETF investors, making sure that we're investing our money. A lot of this comes from 401k plans. When you think of consistent contributions into 401k plans building up, and for a majority of them, including myself, the 401k plan is the largest retirement fund that I hold, meaning it is held over, and I believe mine is State Street that we actually have through my work that is holding my mutual funds or my ETFs essentially, but that is a huge, huge chunk. Now, looking on the right side, property and casualty companies, $3.4 trillion, but 9.9, almost $10 trillion in those life insurance companies, making insurance itself at $13.3 trillion. Now, when we look at the hedge funds, thinking of in relationship to the mutual funds, they're almost 11 trillion, which again, there's a $10 trillion difference between these two. Hedge fund managers definitely control an incredible amount of assets. When we think of billions, nope, we're thinking almost $11 trillion that they're holding over there. Then the banks and credit unions, you can see right here on the bottom, 27.7. So almost $28 trillion is held at financial institutions as it sits today. Kind of crazy to think, again, that the banks on average pay about a 0.3% on average. So when you start adding in the cost of inflation, keeping money at these financial institutions is actually just losing you money. Where on the flip side, when you look at the strong growth of mutual funds, saying that they've grown about 16% in the last year, it's incredible to see when you think 16% on the mutual fund side, a 0.3% by having it liquid in a bank or a credit union. Make sure, guys, that you're moving those funds to those high yield savings. Then we have brokers and dealers running 6 trillion over here to kind of make up and average out what we have here with the 79 trillion in total when it comes to this visual. So overall, like I was saying, banks and credit unions are a great place to house your money if they offer those high yield savings accounts. I have M1 Finance. We have some links down below, also to Robinhood. High yield savings accounts are the place to keep your money, because when you start looking at getting a 4.5% return, it's important that when you have that emergency fund, that it is in something that is outpacing inflation, that you're actually making a little bit of money on it with that emergency fund, because it could be parked for years, possibly even decades. If you have a fully funded emergency fund, you have to make sure that you're doing something with it, that it's growing. And honestly, when it comes to money itself, when you think of having money in the bank, I would much rather have money into mutual funds, into those ETFs, versus having money sitting just in a regular bank account, because the interest that you're losing out is very, very important to be earning versus losing, just like you're being paid interest instead of paying interest yourself by having debt. So guys, that's going to do it for today's video. Absolutely love this visual from Visual Capitalist. It's really cool to see, but let me know in the comments what you guys think. And as always, Thank you guys for watching.